In the semiconductor equipment industry, famous for its brutal boom and bust cycles, there is one company that has managed to break the curse and deliver 6 consecutive years of growth. Applied Materials' newly released fiscal 2025 results not only set a new revenue record, but also delivered a striking forecast that caught the market off guard. The real demand explosion is expected to begin in the second half of 2026. Welcome back to Deep Dive Stock Earnings. Today's focus is a true giant in semiconductor equipment, Applied Materials. Once the headline hype fades, this earnings report reveals something striking: the highest gross margin in 25 years, hybrid bonding technology powering HBM evolution, and a rare forward outlook stretching nearly 2 years ahead. Let's start with an exceptionally rare phenomenon. In a deeply cyclical industry like semiconductor equipment, Applied Materials has delivered its 6th consecutive year of growth. Fiscal 2025 revenue reached a record $28.37 billion. What's even more impressive is the quality of that growth. Over the past 6 years, revenue has grown at a 12% compound annual rate, while earnings per share have compounded at an astonishing 20%. The kind of EPS growth, far outpacing revenue, reflects powerful operating leverage and exceptional execution. This tells us that Applied Materials has achieved something close to a cross-cycle operating model. While peers struggle through downturns, it continues to move steadily higher. The key takeaway is that every tool it sells and every service it provides is becoming more valuable over time, not less. Alongside that growth, profitability has surged to historic levels. In fiscal 2025, Applied Materials delivered a non-GAAP gross margin of 48.8%, the highest in the past 25 years. As semiconductor manufacturing approaches physical limits, tool complexity is increasing at a geometric rate. Applied Materials' deep moat in atomic-level deposition and etch technologies has translated directly into extraordinary pricing power. A 48.8% gross margin is an intimidating number in equipment manufacturing. It reflects extreme non-substitutability for customers like Intel, TSMC, or Samsung. These tools are not optional. Without them, producing the next generation of advanced chips simply isn't possible. Looking ahead, management laid out a central thesis: the proliferation of AI is forcing a powerful virtuous cycle. AI demand drives the need for greater compute capability, which fuels aggressive innovation in chip design, and every one of those designs, ultimately, requires more advanced wafer fabrication equipment to become real. Based on this cycle, the company expects the semiconductor industry to grow at a 10% to 15% compound rate over the next 5 years. This virtuous cycle is really a confirmation of an industry inflection point. AI is no longer just an application, it has become the engine of semiconductor evolution itself. Every step up in compute performance pushes manufacturing processes into material-level transformation, and Applied Materials sits right at the center of that pressure point. To lock in that future, Applied Materials has aligned its R&D around 3 transformational technology shifts. In logic chips, the focus is on gate-all-around transistors and backside power delivery. In memory, DRAM is moving toward 3D architectures to support HBM, and in advanced packaging, most critical frontier companies, KX Systems, are leading the adoption of hybrid bonding to enable higher-yield multi-chip stacking. These 3 shifts directly map to the 3 biggest pain points in AI chips today: energy efficiency, memory bottlenecks, and integration density. Applied Materials' role here is closer to a materials engineering architect. It's not just selling tool sites, helping define how the next generation of chips will be built. One of the most important signals from management came in the form of forward guidance. The CFO explicitly stated that, based on deep engagement with customers, the company is already adjusting its operating cadence to support significantly higher demand. Starting in the second half of calendar year 2026, this effectively lays out a recovery timeline, then suggests that major customers have already allocated capital for upcoming capacity expansions. A forward outlook stretching nearly 2 years is extremely rare in this industry. It signals a high degree of confidence. Why adjust so early? Because advanced equipment has long lead times. This guidance is effectively telling investors that today's calm is just the quiet before the surge's real buildup is already underway. Starting in fiscal Q1 2026, Applied Materials will implement a major reporting change by moving its 200mm equipment business from the services segment into the equipment segment. As a result, The AGS Services Division will consist purely of recurring revenue, stream subscriptions, spare parts, and long-term service contracts. The goal is to clearly showcase the company's high-margin, predictable revenue foundation. I view this restructuring very positively because it improves transparency. In the past, services revenue was mixed with legacy tool sales, making true subscription growth harder to see. After this change, the services segment becomes a clean, recurring revenue engine. Finally, Applied Materials demonstrated formidable financial strength. The company holds $12.09 billion in cash and follows a clear capital allocation strategy. Over the past decade, it invested $25 billion in R&D to maintain technology leadership, while committing to return 80% to 100% of free cash flow to shareholders. In fiscal 2025 alone, it returned $6.03 billion, and over the past decade, share buybacks have reduced the share count by roughly 32%. In summary, Applied Materials is an industry giant that is aggressively innovative on the technology front and exceptionally conservative on the financial side. As the AI-driven second half of this cycle unfolds, the company has positioned itself to break out in 2026. This is Deep Dive Stock Earnings. We'll see you next time.